Life insurance in India is probably the most missold financial product. The moment you start earning, your distant relative would reach out to you and would offer you a life insurance. This has been a story of every family in India. In case you have faced a situation where your distant relative has tried to sell insurance, then let me know in the comments. Now, life insurance as an investment is almost like a ritual in India. So much so that if you haven't invested in life insurance, then you have almost done a crime. While life insurance has been a very important part of our financial planning, the only problem with life insurance is mis-selling. Majority of agents mis-sell life insurance product in order to get high commission. So basically, the focus is on selling life insurance product with highest commission. In fact, not only insurance agent, but even bankers push insurance products. And it is not their fault. Bankers are constantly under pressure to achieve their sales target. And do you know how they pitch their insurance products? So they would say that if you invest just rupees 30,000 for the next 20 years, then we will pay you rupees 10 lakh on maturity after 20 years. And you get excited with 10 lakh figure. Now here, the biggest problem is more than 90% people don't know how to calculate the return on investment. So if you are investing, let's say rupees 30,000 per year for next 20 years, then how much return you are generating on your investment? Now, what if I teach a simple formula that can help you calculate the returns that you would generate on your investment in insurance product? So that tomorrow, if an agent or banker reach out to you with a fancy life insurance product, you can at least do your math to calculate the return on your investment and decide if the product is really good for you or not. Trust me folks, if you know this trick, I can guarantee that no banker or insurance agent would be able to fool you with wrong insurance product. So in this video, I'll show you how to calculate return from investment in insurance within a few seconds. But before that, we'll try to understand why life insurance is important and the different type of life insurance. Let's say you have a family of 4 with a wife and 2 children. You have a home loan of 40 lakh and your wife is a homemaker. It means you are the only breadwinner in the family. Your kids are 5 and 7-year-old. You have a total investment of 10 lakh in FD, mutual fund, etc. Now, unfortunately, let's say if something happens to you, then who will provide financial security to your family? Will 10 lakh be enough? Who will pay the home loan EMI? Who will provide the education to your children? Who will feed your family? And that's exactly the reason why we need life insurance. To make sure that tomorrow if something happens to us, our dependents do not have to worry about money. So there are mainly 3 types of life insurance products: term plan, endowment plan and ULIP plans. Term plan is the purest form of life insurance where you get a high life insurance coverage at a very nominal premium. For example, you can get a cover of rupees 1 crore at as low as rupees 10,000 per year, although the premium would vary from person to person. The only catch is that there is no sum assured on maturity in term plan. It means, let's say you take a term plan till the age of 65 and you survive till 65, then you won't get anything on maturity. Now, if you ask me, every person who has a dependent should take a term plan. But you might ask, there is no money on maturity. So should we take a term plan? I'll answer it shortly. Let's first look at what are endowment plans. So endowment plan is an insurance cum investment product where you get both life coverage as well as sum assured on maturity. That's a dual benefit. Sounds interesting, right? No, it is because in endowment plans, you have to pay a very high annual premium. On top of that, the returns from endowment plans are also very low. So what insurance agents and bankers do is they sell you an endowment plan with a sum assured of 5 lakh, 10 lakh or 20 lakh on maturity, not more than that. And for that, you need to pay a good amount of annual premium. Now just think about it. If tomorrow anything happens to you, will 5 lakh or 10 lakh be enough to take care of your family? No, it is not. Your family can't survive with just 5 lakh or 10 lakh. And what if you have a loan of 40 lakh? Your family will have to sell the home to pay the home loan EMI. So you need a cover of at least 1 crore so that if tomorrow anything happens, your family will get rupees 1 crore, and if they keep this money in FD at 5%, then they will get 5 lakh per year to take care of their expenses, education, EMI and so on. And if you go for an endowment plan with rupees 1 crore coverage, the annual premiums will rip you apart. It would be 30 to 40 times higher than the term plan premium. So basically, endowment plans that looks very exciting with dual benefit of life insurance and investment is not good at any of them. It neither provides a good life coverage nor provides a good return on investment. And hence, I say do not mix insurance and investment. It is better to take a term plan to provide a security to your family in case of an unfortunate event and invest remaining money in mutual funds or stock market where you can fetch much higher returns. Then third, ULIP is a unit linked insurance plan which is also a very popular product among insurance agents. It is basically a hybrid plan where they give you a fixed sum on maturity as well as an additional return which is not fixed. So here the insurance company basically invests your money in stock market. So ULIP is a type of mutual fund but with insurance benefit. Again the same question. Is it a good option? No. The major reason is very high commission. These insurance companies charges a high commission on ULIP plans and your final return is much lower than what you would get from mutual funds. With this, let's come back to our formula of calculating return on investment from insurance product. So here we will take two examples to calculate the ROI on insurance product. In case 1, there's an insurance product where you need to pay an annual premium of rupees 30,000 for 20 years and you will get rupees 10 lakh on maturity after 20 years. What is the ROI on this investment? So what is the annual premium you are paying? You are paying 30,000 per year. And what is the total premium you will end up paying? So it will be multiplied by 20. So for the next 20 years, you will end up paying 6 lakh rupee. And what is the final amount you will receive on maturity? You will receive 10 lakh rupee. Now let's calculate the ROI. So there are two columns you need to create, year and payment. And for the first 20 years, you need to pay rupees 30,000. So since it is a money outflow, you need to put it in minus. So minus 30,000 for the next 20 years and finally on maturity after 20th year, you will receive 10 lakh. Now let's calculate the ROI on this investment. So for that, you need to use a very simple function. Just put equal to IRR, open the bracket and select this entire range and close it. There you go. Your ROI on this insurance product is just 4.65%, which is even lower than FD return. By the way, this is an hypothetical example. So basically you need to figure out what is the premium you need to pay and finally what is the amount you are getting on maturity. So let's say instead of 10 lakh, you are getting an amount of 15 lakh on maturity. Now in that case, your ROI is 8.1%, which is even higher than FD return. So if you think that you don't want to take the risk of volatility in equity market, then you might consider this product. Now let's have a look at case 2, where there's an insurance product where you need to pay an annual premium of 50,000 for initial 10 year and you will get 10 lakh on maturity after 20 year. So basically first 10 year you need to pay the premium and then you don't need to pay. So what is the annual premium you are paying? 50,000. What is the total premium you will end up paying? 50 multiplied by 10 because you are paying for initial 10 year. And what is the final amount on maturity? Again 10 lakh. So here you are investing 5 lakh and you are getting 10 lakh, right? Let's calculate the ROI. Again the same thing, for the initial 10 year you are paying 50,000, so it is in minus, and then you are not paying anything for the next 10 year and finally you will receive 10 lakh on maturity. So what is the ROI? Same function IRR, open the bracket and just select this entire range and just close it. There you go. Your return is 4.52%. Although it might look very good that you are investing 5 lakh and getting 10 lakh rupee, but your return is even lower than FD return. So that is the entire idea. Using this IRR function, you can figure out what is the return you are getting on your life insurance product and then you can take an informed decision. So in this video, we discussed why insurance is important and different type of insurance. Then we discussed a simple formula of IRR to calculate ROI on insurance products. Insurance has been a widely popular and widely missold investment product in India, especially due to every other relative pushing the insurance product to get the commission and meet the targets. Hence, every year many people end up investing in wrong insurance products. But this formula of IRR can be a big savior. It just takes 2 minutes to calculate the return on investment on an insurance product. I hope now you know how to calculate the ROI on insurance. So next time when the agent or banker reaches out to you, you can open the Excel and do the math. Trust me, when you will do this math, the agent would walk away quietly. And it is not that life insurance products are completely bad. It all depends from person to person. If you are someone who doesn't have the appetite to take volatility in equity market, then you might find good insurance products that can offer a decent low risk return. So after the IRR calculation, if your returns are really good, you can consider investing in the insurance product. But this time, you'll make an informed investment decision. By the way, life insurance is just one aspect of your financial planning. There are many other aspects like medical insurance, tax planning, investment, and so on. The ultimate goal is to achieve financial freedom where you don't have to work for money anymore. I have covered all these concepts in my online course on money management. In case you want to explore it, I have provided the link in the description. So if you find this video useful, do share it with your friends and spread the knowledge. This simple Excel trick can help millions of people avoid falling in wrong insurance product. I will see you in next video. Till then, take care.